I have one more hardball for you, because again, I love playing devil's advocate, and I think it's worth talking about all this stuff, because if I'm a whale, this is like my life's net worth, so I'm going to make sure I do all my due diligence. So thinking about keeping everything in crypto, and that's attractive to me as a whale. I can put stuff in cold storage. Nobody can touch it ever. Ownership's a big deal for me. What if I just never sell? I hold everything in there, and in order to do the things I want to do, I go to a money market project like Aave or Compound or Curve or something, and I can deposit my crypto and deposit whatever I want, and then I can borrow against myself, and I can then use that borrowed money to do whatever I need to do and pay for all my expenses. Why would I ever have to sell or have to make any sort of exit at that point?
Great question. So what you're doing there is deferring or just delaying capital gains tax because you haven't exited the position, right? And what you're doing is you're like staking, right? You're 100 million, let's just say, you're like, I'll just hedge against it, and at 30%, 40% LTV or something like that, and slowly just spend it however I want to. And that's the tiger by the tail, and that's one way to do it. Some of the challenges could be that the value of Bitcoin goes from 68,000 down to 35,000, right? And there might be some margin calls, there might be some challenges there, there might be some things there that are part of that. But that's just focusing on the capital gains tax. So the big whales, estate tax, right, is really the big thing to look at. That's the elephant in the room. Capital gains tax is the tiger by the tail. You got to get a hold of that one. But that's not eliminating the estate tax. So hypothetically, you die tomorrow, the kids get the stepped up basis on the 100 million. But guess what? Within 6 months, the government says, "Hey, we need that 40% of anything that was above the exclusion amount from your parents." So is that great? No, that's not great, right? Because now they have to sell anyways. And so, but all of this is assuming that the values stay the same. What we provide with the Deferred Sales Trust is optimal timing. Sell high, buy low, sell high, buy low, right? That's what our parents taught us to do. Not just not sell when we know it's a time to sell because we don't want to pay the capital gains tax. And so, yeah, it goes back to your premise you said earlier. If you're going to sell anyways and you think it's a good time to sell, don't let the capital gains tax trap you from having to not sell, right? Number two, look at your tax flow situation with estate tax. Number three, remember, we can exit a not depreciable asset into an asset which is depreciable, which you can get tax-free cash flow and something that's stable, right? Stable in the sense that it's not going, 30% one day, 30% the next. So it all just depends, right? So I don't know if it's a simple answer, but that is one way to do it. By the way, if you had 100 million, I wouldn't say put 100 million with us tomorrow. You might start with 5 or 10 or 15, maybe 20, and slowly work your way up. That's kind of what my both of my clients have done so far. I mean, she only put 5 million of her 50 million. The other client put 7.5 of the 13 million. And so their dollar costing averaging out